our next guest says that his selling strategy is critical. So what's the best way to manage risk and maximise profit? To take us through it, Jason McIntosh, promotion trader, joins me now live in the studio. Jason, thanks so much for joining me this afternoon on The Trade, your debut. Look, everyone is so focused on where to buy when it comes to the equity market, but of course selling is so important, isn't it?
Yeah, look, it's you're right what you say. I think it's like you look at when to buy, and people are always running around looking for the latest indicators or the latest tip. But I think that buying, of course, it's really important. But there's something which is just as important, if not a little bit more, and it's selling. And I think for a lot of people, selling is somewhat of an afterthought. But when you think through the process, you don't make your money when you buy, you make it when you sell.
Yeah.
So that's why it's just so critical to get right. I'll tell you this fascinating story from back in my early in my career. So I started off on the foreign exchange desk of a global investment bank, and it was back in 1993. So I was the junior trader on the desk, and I was working the night shift. But on Friday afternoons, I'd come in early, meet up with the day team, and then go into the night shift. And so I come into the dealing room one afternoon, Friday afternoon. It's around 4 o'clock, and the trading desk was unusually quiet. And you know, trading desk is like, it's normally like a buzz of activity, pretty boisterous, like carry on. And I sort of look around, I sit down, look across to one of the senior traders I worked with and said, what's going on? And she said, log into the Aussie book, the spot Aussie book, and have a look. So I log in, and there's a $100 million position with $1 million loss. And now remember, this is back in 1993. It's 28 years ago.
So that's a pretty big loss.
Even by today's standards, that's pretty ugly. But back then, it was a shocker. And you see, we had this new spot guy. He'd come on board, come across from another investment bank, and he wanted to make an impact. He certainly did that. And I saw your interview with Nick Leeson a couple of weeks ago, and it's exactly the same sort of story. It's all about an overconfident trader not cutting a relatively small loss early, adding to the position as it's gone against them in the hope that it's going to bounce back, ultimately losing control, and it's just a wreck. And it's just a classic story which is typical of many professionals and retail traders alike. And that's why your selling strategy is just so critical to understand it and implement it and get it right.
Yeah, as we say on the show, it's all about timing. So then how do you decide when to sell?
So look, there's two elements I think people really need to understand. You've got to have your strategy for when to sell a losing trade, and then when to sell a profitable trade. So they're similar, but they're different. So just focusing on the profitable side today, because I think a lot of problems that people get into is they get a small to moderate profit, and maybe it's 10, 20, 30%, and the emotions kick in. They don't want to give any of it back, and they take it. But if you're taking moderate profits, you can never get a really big profit. You can never get 100% plus. So the challenge to be successful, I think, in the trading and also like the investment sphere over time, it's turning those moderate profits into big profits. And the best way I've found to do that, to do that and manage risk at the same time, is to use a trailing stop strategy. And for anyone who doesn't know, that's simply a case of whereas the share price is rising, your trailing stop is following beneath it. So the stock eventually peaks, rolls over, comes down, hits a trailing stop, and you know where you're getting out, you close the trade and you move on to the next one. So it brings some certainty to an uncertain world of equity investing.
Yeah, so when you're using those trailing stops, what are you looking at? Percentage pullback? What type of trailing are you looking at?
Yeah, look, I think there are three main types. So the first type is how I started my career. It's I'd call it the discretionary trailing stop. And we've got an example of this. So this chart here sort of shows how I'd manage a discretionary stop.
So I think this is the Dicker Data one, is it?
That's right, yeah.
Okay, let's have a look at this one.
Yeah, so look, so I've used a hypothetical entry point. So this is sort of like buying a breakout. There's a consolidation, congestion zone, there's a breakout. So then, if we were to enter a trade there, my old way of trading in my early days would have been to have a stop below a previous low. You can see the first red line at the bottom of the chart. The share price starts to runs a bit, forms a temporary peak, pulls back, consolidates, and then now if it runs higher again, that's when you can ratchet your stop up. You ratchet it up, you put it below the next low. And if that series continues and you get this process, you get this series of higher highs and higher lows, your exit level will go higher each time. As you can see, the progression of the red line, it keeps going higher till at some point the market peaks, comes back below one of those low points, hits the trailing stop, and you close the trade. So that's a really easy way for someone to manage a trailing stop strategy. You just need a little bit of understanding of the chart, how a chart looks, and identifying the higher high, higher low sequence.
Yep.
And you're away. No calculations needed. It's all done hand to eye.
Yeah, a lot of those technical traders look at those key support and resistance level, work back from there, don't they? Put in their trailing stop, and then it takes them out. All right, so I know the next one is
next way,
percentage-based trailing stop. We've got an example here that you've got with you. This is Coden. Walk us through this one.
So the percentage based is a little bit different. It involves a little bit of calculation, not much. It's pretty straightforward. It's so the red line beneath the share price is the trailing stop. And the way this one works, a 20% trailing stop, it's simply a case of every time a stock makes a new high, you set the trailing stop 20% below that peak. And it will stay there until a new high is made, and then it goes up. So again, it remains 20% below the peak. So it's a fixed level, remains constant throughout the trade. As you can see in this example, Coden moves around, nothing moves higher in a straight line. There are consolidations, there's corrections, but they've all stayed within the bounds of a 20% trailing stop. And so that's allowed someone using this sort of method to stay in what was a really good uptrend for a number of months. Probably ran for over a year. And at some point it will peak, comes back, hits a trailing stop, and that becomes the time to close the trade. So look, easy to work out. You just probably need a calculator or a spreadsheet to keep track of multiple trailing stops. But it's it's a good way to manage risk.
And the last one, ATR. We're looking at one of the most watched stocks on the platform, that's Zip. Walk us through this chart.
Yeah, now the ATR trailing stop. So this is what I use now. It's more complex. There's a few more moving parts to it, and it requires a little bit more than a calculator to work it out. Essentially what it is, it's working out the average trading range of a stock over a period of time. So I use 30 days, and then I'll multiply that average by 10. Now 10 is not a magic number. It could be 8, 9, 11, 12. But I use 10, that's for me, for a medium-term trend following approach, that works quite well. And now, if you look at the share price, you can see there's an entry point and then there's a share price high a little bit across to the right. And below there you can see the width down to the trailing stop is 52%. So some people would say, hey, that's a pretty wide trailing stop, but this is for Zipco, which is a volatile stock. And it's all about, like, if you want to trade a medium-term trend, you've got to give them room to move. And that's the beauty of the ATR trailing stop. It's dynamic and it adjusts to what's going on with the share price. We move along to the right and you can see that the trading range narrow as it goes into a congestion zone. Those more volatile days drop out of the calculation and the width of the trailing stop drops down to 35%. Then the series continues again. There's more volatility on a breakout, a wider stop. Then consolidation, it contracts again. And this continues until at some point it hits that trailing stop. But this is a great way to stay in a stock because, like, say you're trading a property trust. Yeah. It's not going to be a 52% trailing stop because it's a lot less volatile.
Yeah,
so
exactly.
it's adjusting to each stock. It's a bit like comparing, imagine comparing an off-the-rack suit to a tailored suit. Off-the-rack's probably going to do just fine, but a tailored suit is going to be that little better fitting, and that's kind of what the ATR is.
So are you saying that you'd rather use ATR with Zip over something like a percentage?
Pretty much any stock I'd rather use the ATR because it's going to be tailoring it to that particular stock. So the percentage is great for if you don't really have the processes to work out an ATR, but the ATR is better overall. Now I've got another chart I just wanted to show. It just compares the ATR to a percentage-based stop on Zip. So if you look at this is Zip on the same time frame we saw before, but this time I've set a 25% trailing stop. And look how much closer it hugs the share price. It gives the stock a bit of room to move, but as soon as there's a more sizable pullback, it's because it's not adapting to the volatility in this stock, the trade hits an exit stop a lot sooner. And look, that can take you out of some really good trends that could rise like a few 100%. So you've got to really giving them room to move is optimal rather than fixed percentage is good, ATR based is better.
It's better, yeah. Look, we're running out of time, but we've just got one last chart, Afterpay. You're looking at an ATR stop on this one as well. Just walk us through that chart.
It's interesting to look at like the boom stock for last year.
Yeah.
It has to be Afterpay. And so for this, I've applied the same sort of ATR stop that I use. And of course, it's the red line below the share price. And so the entry point for this, simple entry strategy, it's using a 50 and 100 day moving average crossover, a 70-day breakout high. Haven't put that on the chart because we're talking about the trailing stop. But now, it's interesting, you just think about like how many people would have bought Zipco this time last year. So lots of people got in at that point. Now it's run some up to 300% since there. How many of those people are still in the stock?
Yeah.
And like you look at the chart and there are several corrections in the teens. One comes back 26%. That's pretty hard for a discretionary trader just to stay in. Unless you're a buy and holder, they tend to get bucked out. But the ATR stop, or a trailing stop of any description, it takes a lot of the emotion out of it. You're not second guessing what the market's going to do. You have a calculated exit point. You know where you're getting out. You don't know what the market's going to do next, but you know what you're going to do. You're going to wait until it hits that point. Doesn't work with precision every time, nothing does, but it's about applying a robust strategy consistently over time, and that gives you the law of large numbers. The more you follow something which is good, you're going to maximise your chances of getting on those big trends like Afterpay and riding them 300-400% rather than getting your 20% and going, oh well, wish I would have held.
And I guess the takeaway is that not all trailing stops are made equal. And so you've got to pick your right one for your right chart.
Yeah, look, a lot of people like to protect open equity, so they set a 10% trailing stop. They get the theory, but in practice it doesn't work because stocks that rise 100% have more than 10% consolidation. So you've got to give it room to move. That's sort of the secret to making the whole thing work. And you can get that.
Well, there you go.
You're in with the show.
Yeah, it's all about your selling point. Jason, thanks so much for joining me on The Trade this afternoon. We would love to have you back on soon.
It was fun, Carla. I'd love to be back.